Well, James, one of the main features on the markets this week must really be the strong interest we've seen in the fixed income markets. And of course, Tuesday's bond auction, lots of foreign interest in that.
That's right. It's been an extremely strong week for the bond market, with appetite being in the sort of longer-ish area of the curve around the R186 area as a benchmark. And as you say, this week's auction was extremely strong, and we've just seen that appetite continue. We've mentioned in this program for the last, a good few weeks about the carry trade and how the foreign appetite for higher yields is there and is set to continue. And certainly, last week Monday with the yields on that R186 around 8.5%, we've seen lows this week down at 790. So that's a 60 basis point rally in that stock, which really shows, if anything else, that there is certainly appetite. And technically, it does look like short-term a slight retracement possible, but longer term, at this point, it can continue.
Of course, we have seen foreign interest in the equity market drying up a little bit. Do you think that's being diverted into government bonds?
Most likely, yeah. As just said, if you're looking at the sort of appreciation levels and those high yield levels, it is encouraging to be placing your funds there. We, as investors, generally have been underweight fixed income securities. It makes total sense that they're switching at this point. That's right.
Well, you were talking about strength at the longer end of the curve. How about the shorter end of the curve? What's that saying? And is it still indicating that an interest rate cut is likely at September's MPC?
The real short end, as in the francs, has been pretty quiet the last couple of weeks, with maintaining its discount of interest rate cuts over the cycle around the 70-75% level in the cycle, and going for the next MPC still around that 60% chance of a 50 basis point cut, but really inactive. If anything, in the short end of the curve, we've seen flattening on the 1 versus 2 year area, and but very little activity. If anything, just bank NCD rates coming down on a sort of gradual pace, which pretty much just discounting expectations in line with the francs.
How do you think the retail sales numbers yesterday may have influenced interest rate expectations? Because we had pretty strong growth for June, coming in at 7.4% year on year.
That's it. The retail sales, it's a positive number to look at. Obviously, we all know it was June's number, and there was a lot of benefit from the Soccer World Cup built into that. If you look at the breakdown, you had clothing and apparel purchases on the up. You had appliance purchases increasing. Obviously, all soccer related in that regard, as well as the foreigners in the country would have been spending a lot of cash as well. So I think the more important data or signal to have got from the retail sales figure was that the purchases were mainly on a cash basis. So that means that previous interest rate cuts combined with perhaps above inflation salary increases show that there's a lot more disposable income, or at least a little bit more disposable income in the economy at the moment. So that is a positive, certainly a positive number, but we're not going to see it. We're going to see it decline over the next month or so as the tourists went home and the soccer party ended, so to speak, and we'll return to perhaps a steady sort of retail sales number, but nowhere near pre-recession levels.
We've had a number of key officials making statements over the past couple of days, perhaps starting with yesterday. Deputy Reserve Bank Governor Daniel Manelli speaking about growth, interest rates, inflation and the likes. What did you make of the comments coming out of the Deputy Governor?
There was nothing significantly new from the comments that the MPC gave in the last meeting. I think most importantly from that, he mentioned the strong first quarter growth will be followed by less than stellar second quarter growth, which in Reserve Bank terms is it means that there will be growth, but a lot slower than expected. The rest obviously confirming that inflation at this point is under control. The risks still remain regarding administered prices, wage demands and the currency, but nothing new on the score from Mr. Manelli yesterday, really.
And of course, Finance Minister Praveen Gordhan speaking today, talking about 7% growth needed in South Africa for the next 20 years if we're going to solve our unemployment problems. And that looks pretty difficult to achieve in these circumstances.
That's it. So it really translates back to saying we're going to be stuck with high levels of unemployment for the foreseeable future, which isn't good news, and perhaps just a little sort of warning to the economy in light of wage demands and things at the moment that exist, that a big problem that we have is our high level of unemployment, and it's going to take quite a lot to reduce that.
Of course, at the moment, we also have that strike, and we had Minister Gordhan saying that the strike shouldn't have an impact on growth at this stage. Of course, that would really depend on how long the strike goes on for. Is the strike having any impact on sentiment, though? You've talked about the strong inflows into the bond market. Is this being reflected? Is it being reflected in the rand at all?
The rand at the moment, it seems to be strongly correlated to moves in the euro market. And as far as there will be a few concerns, but I don't think, at least with the comfort provided by Mr. Gordhan's comments, that it won't affect the economy for now. I don't think there's that much translating back. There's talk that the rand has taken a little bit of a negative foot as there are discussions on measures to sort of control the level of the rand that is being bandied around at the moment. There's also talk of the government putting a portfolio inflow tax and discussing that in probably over the next month. So they're there, but I really think we are range bound in the rand at the moment, and it's going to take a significant event to move it out of our range right now.
Just looking forward, not much on the data calendar at this stage. We've got weekly jobless claims coming out later today. Of course, a weekly number. Would this be important to you? Would you rather wait for the more important non-farm payroll data?
Yeah, short term, these weekly numbers, it's worth looking at to build in your expectations for the big non-farm payroll delivered at the start of each month. But really, as far as a sustained economic recovery, the focus has to be on a considerable sort of sustained, as I say, increase in those employment figures in the US and the world economy. So no, it's not going to affect markets that much at the moment, no.